Jim Walker, Managing Director and Founder at Asianomics. He joins us on the show from Hong Kong. Jim, hi, morning. Always good to have you on the show. What's your expectation from Raghuram Rajan's second monetary policy today? Do you think he's going to continue to focus on inflation, which we're still grappling with, and perhaps a rate hike is what we can expect?
I'm sure he will be focusing on inflation. And what we would like to see is him raising interest rates by 50 basis points rather than by 25, and that would be a very, very clear message to the markets and to everybody in India that the central bank is serious about curtailing inflation. Remember, inflation is really caused by monetary and credit growth, and there is a tremendous overhang over the last few years from the money and credit supply that has been coming on board in India. So I think 50 basis points would actually be justified. We suspect it's only going to be 25. But at least that's moving in the right direction and sending all the right signals.
The last time we were chatting with you, the currency was at an all-time low, and I quite categorically remember you saying that this is the time that you would actually go long in the currency. And there we are, all the concerns eased off at 61. What's the next trajectory for the rupee now? Where do you see it headed?
I suspect it's going to stabilise around here. I still think it's a bit oversold at 61.5. I think it really should be in the range 58 to 60 from a pure external balance perspective. But I suspect it's probably not going to get that much higher unless the RBI does the kind of things that we would hope they would do, which is to raise interest rates by 50 basis points. But at least I think that the currency has now stabilised. It's probably not the raging buy that it was at 67, 68. But I would still say that it's an attractive currency, and it will sort out the current account deficit over the course of the next year. By this time next year, we're fully expecting India to be running a current account surplus.
Jim, as of now, liquidity signals are blowing strong. Everyone is convinced that Fed will print more, taper will get delayed. But tapering eventually will happen. What happens when tapering starts?
Well, I hope what happens is that we'll start focusing on fundamentals again, and that will actually give people a much clearer idea of what's going on in emerging markets. India is going through a very rough patch at the moment, but you know, it's actually repairing itself. From our perspective, and we come at things very much from the Austrian school angle, recession, and we would really say that India is in recession at the moment. It's got a very, very low growth trajectory, much lower than its potential. That's the recovery phase as companies and businesses begin to shake out bad investments and effectively put their house in order, their balance sheets in order. So we're actually thinking that India is beginning to look quite interesting from an investment perspective. But it certainly wouldn't be helpful, I would say, if this largesse continues from the US, because that hasn't helped emerging markets. If you look at the underperformance of the equity indices over the course of the last 3 years in emerging markets, that's what QE has done. It's really clouded the picture rather than focusing on fundamentals. And I think once we start focusing on fundamentals again, emerging markets are actually going to look quite attractive. And if that focus comes probably second quarter of next year, India is going to look very attractive.
Jim, you just talked about, expecting a 50 bips hike from the RBI, maybe not this policy, but by next one for sure. Do you think that is something which is going to disappoint the equity markets? Or a 25 bips hike this time at least is something which is already in the price?
You know, the interesting thing if we look at India is that the equity markets are bifurcated. The BSE 500, the Sensex is at almost all-time highs. There are very good companies in those indices, and that's probably why. But when you get into the mid-cap stocks and the small companies in India, they've been crushed over the last few years. So, I think equity markets have correctly identified where the problems are. They're really not focused on, they're focused on the very large good companies, and so they should be. But I don't think it's really the prospect of equity markets and problems in equity markets that we should be focused on just now. It's corporate earnings and whether or not the corporate earnings are going to come through. I think interest rates are now a sideshow as regards the equity market.
Jim, whereas we keep on talking about structural problems in India and what policymakers should do and they need to do, currently India seems to be the tallest off, because for US economy growth is tenuous. We don't know which way China is headed, and certainly Europe is in a mess.
Yeah, in a lot of ways I think that's right. And as I said earlier, I think India is repairing itself at the moment. I'm not saying the government's repairing itself. I still think the government has a lot to answer for over the course of the last 4 or 5 years. It's going to delay subsidy payments again to try and dress up its fiscal deficit this year. But when we look at the private sector, and this is always what makes us excited about India, when we look at the private sector, we can see companies writing off debts, and that's the way that you've got to do it if you can't repay your debts. They're repairing their balance sheets by cutting capital expenditure. That's bad news for economic growth in the short term. It means that the companies are actually improving their financial position. And when companies improve their financial position, it gives them the springboard to move forward into the next phase of the, if you like, the boom, the upcycle. It doesn't require borrowing at that stage, and that's why I don't really care about interest rates here. I think interest rates should be focused on taming inflation, because companies will be generating internal cash in a way that will allow them to start expanding capital investment again, I hope by the middle of next year. So I think there's actually quite a lot of exciting things happening in India just now, if we exclude the government from our vision.
So what's your broader prognosis? Do you think the party for emerging markets, and especially for India, will continue till the time we don't get a definitive timeline on tapering, and the minute we get a definitive timeline on tapering, markets will start adjusting themselves?
I've never really been convinced that emerging markets have been acting on the back of quantitative easing and all the loose money that's been spreading around the global economy. Certainly, some of the debt markets have been affected by the search for yield on the part of fund managers, pension funds, etc., in the Western countries. But at the same time, when you look at the kinds of places that they were putting money into, and the kinds of sovereign debt that they were putting money into, it's hardly surprising that they were coming to emerging markets where fiscal deficits and the debt to GDP ratio is so much below what's happening in the West, whether it's in the United States or Europe. So there was good reason for people to be coming into the fixed income markets in a lot of emerging markets. And at the same time, if, as I said earlier, you look at the emerging market equity indices, they've underperformed for 3 years. So what happened to all this QE and its largesse? It certainly wasn't flooding into emerging markets. Effectively, it's been flooding into developed countries. So to be quite honest, the sooner that it goes and we start tapering down and people start focusing on economic growth fundamentals, on the demographics, on the outlook for the next 5 to 10 years rather than the next 5 to 10 minutes, which is what QE basically suggests that people should do. Once we start looking at that, that's when emerging markets are going to start taking off again, because I think, in general, they're in pretty good shape, especially Asia.
Jim, you just talked about as to how the FII fraternity is going to monitor the RBI moves as well, and how investors back home as well as you would watch out for how earnings pan out in India. What's the view then on the overall market? With the rupee having stabilized, but we're still grappling with a high inflation, do you think the index moves still have further upside from here, or do you think the upside in the equity market is now capped at around 6,100?
Now, I would have liked the index to be much lower than it is just now, so that I could be telling my clients this is time to buy India. The equity market indices have actually held up, especially the Nifty and the Sensex have held up particularly well right through the last year, when you would have expected them, really after all the bad news that's come through about government deficits, the currency, corporate earnings, rate of economic growth, to have fallen pretty dramatically. So it's very difficult when the markets haven't reacted to that to assume that there's worse news to come. I just don't think there is. So I fail to see where the downside is for Indian equity markets, unless there was a major sell-off in global equity markets, you know, a 1987 style stock market crash or a Y2K style stock market crash. That would affect everybody, but those major global events aside, I really do find it quite difficult to see where the weakness is going to come in these major indices in India now. So with that in mind, I don't think people should be selling.
So at 6,100, at what level would you then turn a buyer? And B, there are pockets like for example, IT, wherein the earnings have been good and we've been seeing some profit taking coming in. Would you now turn buyer in such sectors then?
Yeah, I think it's a bit early. I think that there's worse news to come on the economy. I think there's worse news to come on monetary policy. Hopefully there's better news to come on politics as we near the election, and therefore better news to come from a government deficit perspective. But I do think it's a bit early to be enthusiastic about Indian stocks at the moment. I think we're probably in a hold pattern for the next 6 months.
Jim, let's look at the valuation argument for India. And let's keep those 15-20 stocks aside. They are expensive, they are priced to perfection. But 80% of the market or 75% of the Indian market is trading at historic low. Banks have gone below book. You've got consumer names which are expensive, but metal stocks are completely beaten down. Industrials are also trading at historic low. Should one focus on that end of the market?
It's an interesting question. The one thing I would always caution about banks at this stage in the cycle is that book's probably not correct. I think there's likely to be some bad debts over the next 6 to 12 months that are going to impair the ability of the banking sector to actually move higher. But your question about the cyclicals and the metals and the industrials is really interesting. Again, I think we might be slightly early in this respect, but it's actually where I would be looking over the course of the next 6 to 9 months to start accumulating beaten down stocks. I think, as you quite rightly say, the 20-odd names that are priced to perfection, which are very, very good companies in most instances, and therefore should be priced like that, we can leave aside. But we should really be starting to look for value in the cyclicals. Jim,
good having you on the show. Appreciate you taking the time out and sharing with us your views. Good to have you on the show as always.